I came dangerously close to wiping out 10,000 euros from my portfolio in a single day. And the scary part is nothing about it looked like a mistake at the time. No alarms were going off in my head. No feeling that I was being reckless. If anything, I felt confident, calm even. I remember looking at my screen thinking, this is a smart move. A few hours later, I realized I'd almost made the most expensive investing decision of my life. Not because the market crashed, not because the investment itself was terrible, but because of something far more dangerous. Overconfidence mixed with just enough knowledge to feel certain. And if you've ever invested money, even a small amount, there's a good chance you've been much closer to this situation than you realize. The truth is, the biggest mistakes in investing rarely feel like mistakes while you're making them. They feel like opportunities. Let me walk you through exactly what happened. Don't forget to subscribe and share this, because the lesson that came from that day changed the way I think about money, risk, and investing entirely. A few years ago, I reached a point where my investing journey started to feel comfortable. I had been learning for a while, reading about markets, watching charts, understanding things like diversification, long-term investing, compound growth. Nothing too advanced, but enough to feel like I wasn't guessing anymore. And when that happens, something subtle shifts inside your mind. You stop feeling like a beginner. You start feeling like you get it. That's when investing becomes dangerous. Not when you know nothing, but when you know just enough to trust your instincts a little too much. Around that time, I had built a portfolio that I was actually proud of. It wasn't massive, but it represented years of discipline. Saving instead of spending. Choosing long-term growth over short-term comfort. Slowly building something that felt meaningful. And inside that portfolio was about 10,000 euros, allocated to a single opportunity I believed in strongly. Not a random gamble, a calculated bet. At least that's how I saw it. The market at that time was full of noise. Everywhere you looked, people were talking about the same thing. Charts going up, new opportunities, stories of people doubling money in months. You probably know the environment I'm talking about. When optimism starts to feel normal. When risk slowly begins to feel like opportunity. When hesitation starts to feel like you're missing out. And that's exactly the environment where my mistakes started forming. Not with a bad investment, but with a subtle shift in thinking. Instead of asking the usual question investors should ask, what could go wrong? I started asking a very different question. How much could this make? It sounds small, but that shift in mindset changes everything. Because when your brain starts focusing only on upside, risk becomes invisible. And once risk becomes invisible, decisions start getting bigger. That's exactly what happened to me. I remember the specific day very clearly. Markets had been moving aggressively for weeks. Prices climbing faster than usual. Every day it felt like confirmation that the thesis was right. That feeling is powerful. When your ideas appear to be validated by the market, confidence grows quickly. And confidence, if you're not careful, slowly turns into certainty. I logged into my account that morning and saw the position moving again. Up, green numbers across the screen. And in that moment, my brain started doing something dangerous. It started calculating what would happen if I increased my position. Not slowly, not carefully, but significantly. If this opportunity was already working, why not lean into it more? That thought feels logical. In fact, a lot of investors convince themselves that concentration equals conviction. But conviction without humility can destroy portfolios. What I didn't realize at the time was that I had slowly stopped thinking like an investor and started thinking like someone trying to win. There's a difference. Investing is about surviving long enough for good decisions to compound. Winning is about being right quickly. And that day, I wanted to be right. So I considered moving almost 10,000 euros into that single position. Not as a long term allocation, but as a heavier short term bet. The kind of decision that feels bold in the moment, but fragile underneath. And here's the part that still surprises me. I didn't feel nervous. I didn't feel reckless. My brain had already justified the decision. I had charts. I had analysis. I had reasons. But reasons are not the same as protection. Because markets don't care how confident you feel. They care about probabilities. And probabilities rarely respect certainty. Before making the move, I stepped away from my desk for a moment. Not because I doubted the decision, just to get some coffee. And that small pause ended up saving me 10,000 euros. When I came back, something had changed. The price had moved sharply downward. Not a small fluctuation, a real drop. The kind that instantly reminds you that markets move both directions. I watched the chart for a few minutes. At first I told myself it was nothing, just volatility, just a temporary pullback. But as the minutes passed, I realized something uncomfortable. If I had placed the trade when I first opened my account that morning, I would have been sitting on a massive loss within hours. Not a theoretical loss, a real one. Thousands gone almost immediately. And suddenly the confidence I had felt earlier that morning looked very different. It looked fragile. It looked emotional. It looked lucky that I hadn't acted yet. That moment forced me to confront something I hadn't fully understood before. The biggest risks in investing are rarely visible when things are going well. They hide inside success, inside momentum, inside the feeling that you've figured something out. And when those moments arrive, the brain starts doing something dangerous. It rewrites the past. Every correct decision starts feeling like skill. Every gain feels earned. And slowly, quietly, the possibility of being wrong starts fading from your awareness. That's exactly where I was. Not reckless, just overly certain. And certainty in markets is expensive. The interesting part is that the investment itself wasn't the real mistake. The mistake was the position size. That's a concept many people underestimate when they first start investing. Because when we talk about risk, most people focus on what they're investing in. Stocks, crypto, real estate, funds. But experienced investors know something deeper. Risk is not just about the asset. It's about how much of your money is exposed to one idea. Even great investments can become dangerous when they dominate your portfolio. Because the larger the position, the smaller your margin for error. And markets, by nature, deliver plenty of error, volatility, unexpected news, global events, sentiment shifts. All of it can move prices in ways no spreadsheet can predict. The mistake I almost made that day wasn't believing in an opportunity. It was concentrating too much of my financial progress into one outcome. And when I realized that, something inside my mindset shifted. Not dramatically, but permanently. For a long time, I had thought investing success came from finding the right opportunities, the best companies, the strongest assets, the smartest ideas. But after that moment, I started seeing something different. The best investors aren't the ones who predict the future perfectly. They're the ones who survive uncertainty consistently. They respect the unknown. They leave room for being wrong. They structure their portfolios so one bad decision doesn't erase years of progress. Because here's something nobody tells you early on. Compounding is fragile. It grows slowly, patiently, year after year. But one large mistake can undo a shocking amount of time. That's why protecting capital matters just as much as growing it. Maybe more. That realization changed the way I approached every investment after that day. Instead of asking, how much could this make? I started asking a better question. If this goes wrong, what happens to me? Not to the trade, not to the chart, to me, my finances, my progress, my peace of mind. That one shift alone eliminates many bad decisions before they ever happen. Something else interesting happened after that day. My investing actually became calmer, which sounds strange. Most people assume better investors are more aggressive, more active, more decisive, but what I noticed was the opposite. The more I respected risk, the less urgency I felt. I didn't feel the need to chase every opportunity, or maximize every move, or prove that I could predict markets. Instead, investing became quieter, slower, more intentional. I started building positions gradually, diversifying more thoughtfully, accepting that missing a little upside is often the price of protecting the downside, and that trade-off is worth it. Because financial progress isn't about perfect decisions. It's about avoiding catastrophic ones. And the day I almost lost 10,000 euros taught me exactly how close those catastrophic decisions can appear to normal ones. You might be wondering something right now. Does this mean you should never take risks? Never concentrate on ideas you believe in? Never move decisively? Not at all. Risk is necessary. Without risk, money doesn't grow. But there's a difference between calculated risk and emotional conviction. Calculated risk leaves room for uncertainty. Emotional conviction assumes the future will cooperate, and markets rarely reward assumptions for long. The healthiest investing mindset I've found is somewhere in the middle. Confident enough to act, humble enough to prepare for being wrong. That balance keeps you in the game long enough for compounding to actually work. If you're someone who invests, whether it's 100 euros or 10,000 euros, there are a few simple habits that can protect you from the mistake I almost made. The first is pausing before increasing a position dramatically. Big decisions deserve breathing room. Even a few hours can reveal things your excitement hides. The second is imagining the downside before celebrating the upside. Not to scare yourself, but to stay grounded. And the third is remembering that investing is not a race. There will always be another opportunity, another market cycle, another moment where patience beats urgency. Most financial mistakes happen when people feel like time is running out. It usually isn't. And that small realization alone can save a lot of money. When I look back at that day now, I don't feel embarrassed. I feel grateful. Because the mistake revealed itself before it became permanent. It showed me a blind spot in my thinking. A blind spot that could have cost far more later in life. And that's something many investors never get. A close call that teaches a lesson without destroying the portfolio. Those moments are rare, but if you pay attention to them, they quietly make you better. More aware, more disciplined, more patient. Not just with money on it, but with decisions in general. If there's one thing I've learned about investing, it's this. The market is an incredible teacher, but the lessons rarely arrive in comfortable ways. Sometimes they show up as volatility, sometimes as missed opportunities, sometimes as close calls that reveal the limits of your confidence. And if you're willing to listen to those lessons instead of ignoring them, your financial life slowly becomes more stable. Not perfect, not risk-free, but stronger, more resilient. And that's ultimately what investing should give you. Not constant excitement, but increasing peace of mind over time. If this story felt familiar to you in any way, if you've ever felt that pull to go all in on something you believed in, then you're not alone. Almost every investor faces that moment at some point. The important part isn't avoiding every mistake. It's learning from the ones that almost happen. Because those moments shape how you approach the future. And that's where real progress begins. If you found this helpful, feel free to stick around and explore a few more conversations like this. This channel is really just a place where we slow down and think more carefully about money, decisions, and the psychology behind them. No pressure, just thoughtful ideas that might help you make calmer, smarter financial choices over time. Subscribe. Leave a comment if that sounds like something you'd like more of. You're always welcome here.